Hello, everyone. Welcome to our discussion of how our accounting events affect the financial statements and ratios. Now that we know about the uh, accounting equation and the expanded accounting equation worksheet as to measure how things are changing with various events and transactions, now we can actually see how this plays out on the financial statements. But before we do that, we need to talk about a couple of things that are really important in terms of how things change on the financial statements. So we're going to talk about perhaps what we might consider the lifeblood of our business, and that is what we refer to as the cash collection cycle. The idea is we sell things and to our customers, and then we have to collect from them the money that we sold it to them. So we can sell it to them for cash, but we can also do it other ways. So the reason why this is so important is because cash is the essential asset for every business, meaning you have to have it to do business, to pay your bills, to pay your employees, that sort of thing. But cash is not very effective. It doesn't make you any more money. If you just have a pile of cash, it's not going to do much for you. So businesses are always taking their cash asset and converting it into something more useful, and then using that to create revenues, collecting more cash, and so it's a cycle. And then they use that cash to buy more effective assets. And so that's how this cycle works. And when we're successful, we just do it in a very profitable way, and we're able to keep that going on a constant basis. If we have trouble with that, then we're not going to do well as a business. So we quickly realize we have to measure what we refer to as liquidity. It's the measure of having cash resources that you need to meet obligations and to capture opportunities. So, for instance, if you don't have any extra cash, and some opportunity to buy a new machine or some other thing comes along, you may not be able to take advantage of that. You may not be able to capture the opportunity of expanding your business if you don't have any additional cash. But you don't want to just have the cash sitting around again, just in case. So it's always a balancing act between having cash just sitting idle and not having enough to take care of things when it needs to happen or to go after opportunities. So we actually think that this is so important as the balance sheet in accounting is listed by liquidity. So if you may have noticed, cash is usually the first asset on the balance sheet because it's the most liquid. Obviously, it's the most available to utilize to pay our bills. Everything else after that is in order based on how easily it is to take that asset, turn it into cash, and then pay our bills. Okay? So that's how important we think it is to be able to have access to the resources to pay our bills. The other problem with cash is that it's a risk of loss and error. Because it flows through our business in such a way and it has so many different transactions and so many ways that people have to access it, it has a lot of things that could happen to it, and it's the most likely asset for someone to want to steal. So we need our best internal control procedures. And if you're going to be able to put those internal controls in place, you must understand this cash collection cycle. How does it work? Where does it go? How does the money flow through our business? If we don't understand it, we can't protect it. So that's why this cycle is so important. If a company is losing this cash because of fraud or some other problem, they're not going to survive very long. So you decide that you need to have your cash and cash more quickly. So you've got sales. So the first thought you might have is, all right, let's just sell for cash. I won't sell to anybody unless they hand me currency, unless they have $20 bills to pay me. And there's a few businesses out there that are still operating that way, but not very many, because most customers demand more convenience than that. They demand more ways to pay than cash sales or even checks. And because people have gotten so they don't like to carry cash, they know it has a risk of loss. If they carry wads of bills around, they could lose it. They could lose their checkbook too. So they've moved away, customers have moved away from that as a way to pay, especially if it's retail. Credit card sales have become the substitute in many cases with retail customers. Credit card sales get our money. If we sell somebody something and they pay with a credit card, we get our money pretty much the same as cash. What happens is that person at the point that they're buying our stuff is taking out a loan from the bank instantaneously for that customer to pay us. Now, it's not what it looks like. It looks like they just swipe a card, but that's what that card is doing. It is setting up a loan where the bank that issued the card is loaning to our customer the money they need to buy our stuff. And the cash is going to come directly when we feed that credit card data to our bank. It's going to then get the money from the bank that loaned the money to our customer, and it's going to go into our account, usually within 24 to 48 hours. All right. However, both banks are going to take a little piece of that. Okay. And the credit card company with Visa, MasterCard, they're all going to take a small piece of that. And so we're not going to get the full amount that the customer was willing to pay. So if I sell something for $100, I may only get $98. That other $2 is going to go to the banks and the credit card company in between. And I'm willing to give that $2 up because I don't have to worry. The customer has a nice, convenient way to pay. They got their plastic. They can carry it around. They don't have to carry cash. They can pay. But I don't have to collect from them. That's the bank's problem. The bank that issued the credit card checks their credit, collects from them, sends them the bills, all that good stuff. All I do is send in the receipt from the sale and get the money deposited in my account. I don't even really have to worry that much about credit card fraud. That is the credit card company's problem for the most part as well. So, I mean, I've got to keep, if I store all that information, then I better make sure that it's protected from hackers. Target and others have gotten into some big trouble by making that available or having that get hacked into. But for the most part, I'm willing to pay that percentage so that I don't have to worry about all that paperwork and such. I just get a cash sale, really. So that when we use the term in accounting, a credit sale, we're not referring to credit card sales. We're referring to this third category where I tell a customer they can buy something today and pay me 30 days from now. It is pretty unusual in the retail environment. We don't have that happen. We pay when we go to the store using cash or a credit card, maybe a debit card, which is cash as well. But businesses, when they buy and sell from each other, often use credit sales because they're making lots of transactions, maybe sometime multiple times a day, and they don't want to pay every time that happens. So credit sales allows them to pay once a month for all of the sales or purchases they made. So when that happens, we're going to utilize as we're the seller, accounts receivable, that's what we're focused on as seller here, we're going to increase accounts receivable and increase revenue. If it has inventory involved, we're going to debit cost. We're going to increase cost of goods sold and decrease inventory as well. But we're focused on the account receivable part of that for a minute. The accounts receivable is going to go up and revenue is going to go up. Now, when you sell on credit, there has to be an agreement as to when you're actually going to get paid. That's what we refer to as the credit terms. It may be that if you sell on cash, you don't have to have any credit terms. Okay, but if you make a credit sale, there has to be an agreement that you're going to collect, or the company is going to collect from the customer at some future time. And so some statement of those terms needs to be agreed upon. It's going to be 30 days, 60 days. Am I going to offer a discount to pay early? All of those things need to be agreed upon in the credit terms. Now, before we do that, we probably are going to check the background of a customer to see if they've paid their bills in the past, because we should understand that at the point that we allow them to buy now and pay later, there's a possibility that something bad could happen in between the time that we sell to them and when they pay it, it's time to pay them, that will cause them not to be able to pay us. And we want to check and see their financial condition to try to see what the possibility of that happening is, and try to reduce that possibility by only selling to customers that we think are pretty sure are going to pay us. So we might check their credit. But despite that, there may still be a possibility that they will not pay us. And that's what we call the allowance for uncollectible accounts. So this is a new column, if you will, on our worksheet having to do with assets. This is the amount of the sales on credit that are not going to be collected. So anytime we sell on credit, there's a possibility that some, probably a very small percentage, because we checked, are not going to pay us. And we won't be able to collect. That's what we refer to as, we're going to estimate it and call it the allowance for uncollectible accounts. Remember, we talked about estimates and when that is necessary. This is an example of doing that. Okay? And so we make that estimate to do that. And we want to make sure that we want to do all we can to make it small. Okay? And to make the collections, to get the money from our customers quickly. All right, so we want to be very good to them. We want to follow up with the customers so that they will pay us on time, because the longer they take to pay us, the more likely something bad is going to happen and make it so they can't pay us. Okay, so when we're estimating this amount, all right, we're going to use the past to kind of estimate. We're going to look at the economics. In a time when every company is hurting, there's going to be more likelihood that the companies you sell to are not going to be able to pay you. All right, and of course you can't anticipate everything, but you try to look and see what the possibilities are and try to estimate it, usually as a percent of what you've sold. Again, you don't know who's not going to pay you, so you estimate from the total some small percentage that are not going to pay you. So on the balance sheet, there's going to be an amount of accounts receivable. That's the total accounts receivable. That's everything every customer owns. Now, if you're a Nike and you're selling to hundreds of different customers, your accounts receivable is a list of every customer and how much they owe you. That's the accounts receivable. Then you have the estimate of how much that whole pile of money that's owed to you, how much of that you're not going to be able to collect. That's estimated. You subtract that, or you take it away, and then that equals what's called net accounts receivable. That is usually the only number that is reported on a real life balance sheet. That's how much you actually think you're going to collect. So you've got the total owed minus what you think you're not going to collect equals what is reported on the balance sheet as net. Remember, the term net means something's been subtracted in accounting, so we subtracted out the allowance. So if I look at my chart here for the accounting equation, I've only really got assets and equity because my liabilities are really not what we're talking about. But just so you understand, the accounting equation still is in balance here. When I make a sale, or lots of sales, I'm going to increase accounts receivable and increase revenue. When I estimate how much the people are not going to pay me, I'm going to make my allowance, all right? And I'm going to, because it is a reduction, I'm going to increase my allowance, let's say 2,000, and increase my bad debt expense. Okay? Now, we've usually used that as a negative on the expense because it's subtracted, and we're going to go ahead and do that on the allowance. So it goes in the asset section, but it is a reduction. So on the balance sheet, we would show 100,000 minus 2,000. The amount we actually expect to receive is 98,000. On the income statement, we'd have the revenue and we'd have the expense. Now we have the bad debt expense matched in the same period as the revenue from selling on credit, because one of the expenses or costs of selling on credit is the fact that we might not collect everything. And so we need to match that up. So that's how it works on the accounting equation worksheet, and then flows to the balance sheet.